Good afternoon, everyone, and welcome to Stock Market Today by Investors Business Daily. It is January 13th, a Thursday for 2022, and it's Justin Nielsen here along with Ed Carson while Ali Quorum is on vacation. Rough day in the market today. We'll take a look at some of the things that were going on underneath the surface. Started out really good with some great action from Taiwan Semiconductor. We'll also take a look at some setups in Simon Property and really good action in JPMorgan and some of the financials that were setting up previously, but a lot of those have earnings coming up and wasn't a great close. So we'll take a look at those. Looking at the markets, we had really rough action. S&P 500 down 1.4%. Nasdaq Composite down 2.5%. That was the worst hit. Dow Jones Industrial Average only down 0.5%, and the Russell 2000 down 0.75%. So Ed, let me ask you, what happened?
I don't know. I'll be honest. I don't know. But you can also just look at this chart. We talked about it last few days. Monday, we were sort of due for a bounce. There was a lot of indicators why we might be ready for a bounce, not the least of which the Nasdaq undercutting the 200-day line. Okay, so we got a bounce, and then we got a bounce Tuesday. But then on Wednesday, we rose more than 1%, and then basically just eked out a small gain. And all the major indexes hit resistance at the 10-day line, which is not normally this massive, barricade to stop thing, but okay, fine. Today it started off okay, and then it just built a momentum, started up positive, then turned mixed, and then everything was dragged down by growth. And there were some really big losers out there, and some of the more highly valued you are, right, the bigger the losses. But it was pretty broad in this case.
Yeah, as bad as the Nasdaq looks, there's some of these stocks that look even worse, with a lot of them, trading below their 200-day moving average lines. But it still is a little bit of a tale of two markets, with the S&P 500 really kind of hovering right at its 50-day moving average line. So it did close, looked like it did close below that today. So is that potentially putting us in a little bit of a shaky occurrence here?
I think we are in a shaky, situation, because now we're back below the 50-day line. Really, it's the worst close in several weeks. Actually on this one, could we bounce back? Sure. It's like the S&P isn't really that far. This is where it's found support for several months, really over the past year, but it's not positive action here. And if you buy on strength in this kind of market, you're always going to end up down, it seems like, a day or two later. So that makes it really hard. Again, even if the market trends up, you can get chopped up. And so it's just like, that's really psychologically, frustrating to watch, something like the S&P trend higher. But this is hard to trade. This is really, that's hard to deal with. And that's not as volatile as a lot of individual stocks.
Right. And I should note that, a lot of times I take a look at the sector funds, the spider sector funds, and we're kind of back to what's working today, utilities and consumer staples. It was definitely a defensive nature, where tech got hit the hardest. Over on the Russell 2000, if we take a look at IWM, the Russell 2000 iShares ETF, that really hasn't been doing much of anything. It's still, below the 200-day moving average line, the lagging index. And the Dow Jones Industrial Average, that was down 0.5%. It's kind of in line with what's been going on with the S&P 500. This is, the DIA, the Dow Jones Spider ETF. It's really kind of right there at the 21-day moving average line. So at least that is holding above the 50-day.
Yeah, that's doing all right in that regard. And, it's just a situation where even though it's like, okay, this is doing better, but it couldn't hold up. And that's part of what makes a mixed market so difficult. It's like, yeah, okay, a couple negative scenarios. Either you have something like today where the whole market comes down and ultimately the stronger sectors still fall down. Or what if we shift back? What if we shift back into growth? Well, then the Dow and all those industrial names and some of those financials, energy, maybe they lag or decline. So it's just really difficult to navigate in this kind of market.
Yeah, it can be really, really easy to make mistakes, really unforgiving. So let's take a look at some of the stocks now. Taiwan Semiconductor, ticker symbol TSM. This had a pretty good earnings report. It had already reported sales, but closed well off the highs. Is this still worth looking at, or is this something that gives you pause when it closes that far off of its highs?
Yeah, that's not great. That's always one of the concerns with an earnings gap, is that it'll fall off. Now, this didn't give up all of its gains, but I'm just going to quickly switch over to a 5-minute chart. This first, it's a 1-minute bar, but you can see it looked strong at first, where the market was doing well, and then it came down and it basically closed near the lows of the day. And so if you bought it in this first hour, you're sitting down, and it's no fun to be down on a stock that was one of the best performers that day.
Right.
But in this situation, I think that if maybe it consolidates here, and it's harder to see on this, chart, but I'm going to go to a weekly. Let's say it consolidates here. It has this big saucer base. This could provide another entry point, or like sometimes with the gap up is that, well, you wait a few days, see if it holds that gain. And, maybe if the market steadies here, it'll steady, and then they'll provide another opportunity. And if the market slides, that's the other risk, is that we saw with Tesla last week, huge gain, and then the market sells off and it gives up all that gain, because that's the kind of market it is. So that's how, maybe waiting a few days, see if it could sort of form some kind of shelf or essentially a handle to that bigger base.
Yeah, certainly a pause right here would be fairly constructive, and that's something that we could see in the market indexes as well. That would really help out, because there are a lot of stocks that have kind of zoomed up from the bottom a little bit, and some pauses there could make for more setups. One thing to note here is, for as much as this looks like, oh, look, this closed at the lows of the day, well, this really did have a big gap up there. So if you kind of looked at the true range and kind of filled in that bar, this is more in the upper part of its range, really. And I think the fact that you showed the weekly chart really kind of illustrates that fact that, when you look at the whole week, this is really still a very positive week that's not too far off its highs. It's certainly in the upper part of that range.
Absolutely.
Let's go ahead and take a look at Simon Property now. Of course, with everyone looking at malls and what's going on with a lot of empty spaces there, you might wonder what's going on with Simon Property, that this is their space, and this is a really good looking setup, and it just doesn't seem like this has been bothered at all by what a lot of people fear is going on in retail.
Yeah, it is surprising, some of the names, so much property, some of these REITs are having really strong growth. And I'm not sure why it's doing so well, but the growth has picked up. Some of it may be easier comparisons, but nonetheless, decent growth there. Stock is setting up, after a nice run here. So nice action here. The relative strength line isn't at a high, but it's already above the handle high. And, while traditional breakouts haven't always worked, this is awfully close to the 50-day line. This is almost like an early entry in its own way, because this is nice. And you tack on a 4% dividend yield, and there's some positive aspects about this for sure.
Yeah, and certainly we don't usually look at things just for the dividend itself, but this is one that has, if you go to the weekly chart, it has shown a propensity to be able to move. So if you can get some capital appreciation, and that dividend just becomes a little bit of gravy on top, that's something that can really help out your portfolio. And look, maybe it's not time to count retail out. Certainly, I was real surprised that the department stores did so well last year. Macy's and Kohl's and those. It was one of the top groups for a long time. So maybe this is just a part of that move that we saw last year.
Yeah, this might be a little bit safer. It's not exactly picks and shovels, but they're paying their rent, and it just may be a little bit, steadier than some of those retail names.
Now, certainly with earnings coming up, all eyes are going to be on a lot of the financial stocks. And, as bad as the day was, a lot of these weren't doing too bad. JPMorgan certainly held up fairly well. This has earnings tomorrow, along with a slew of others. So what's your take on what's going on with the financials, especially since we still have those Fed concerns about what's going on with the taper, what's going on with rate hikes, and so on?
Yeah, obviously bond yields have been rising quite a bit. That's a big factor for the treasury yields. And Jed Graham was written a lot about the Fed. He wrote something today about the quantitative tightening. As they reduce the balance sheet, that actually could be favorable for the banks, because it would actually encourage the long-term yields to rise in a way, as opposed to the short-term rates. And so there's even that factor. But yeah, this one has been setting up. You could argue that in the absence of earnings, this was still actionable. It sort of had this early entry here, really hasn't moved too much since then. You could have done that in that regard. It's not that far above the 50-day line. Again, sort of hitting resistance at this area. It has a traditional buy point up here. I think it's acting pretty well. I know that we often talk about that banks have not been great performers in the long run against the S&P 500, but they do have stretches where they can have strong periods of outperformance. And if you think the economy is going to be relatively strong, and if you think interest rates are going to rise, that's a pretty good scenario for banks, all in all, especially if growth stocks get whacked by higher rates.
And certainly, if you're looking for an area that, with all the back and forth that's happening in a lot of the indexes, sometimes you are looking for a little bit of outperformance from an area on the short term, at least. So certainly, the financials have been providing that, and not just the banks, but some of the insurance companies as well are certainly worth looking at. Any final thoughts, Ed, on what folks should do now?
I think you just have to have more of a defensive mindset. If you do buy things, it was something that Harold Morris, who returned to IBD Live today, position sizing, and trying to keep it pretty close. Keep buys, look for early entries. Don't buy high, well away from the 50-day line. You really want to play it close to the vest. This is not a time that you can get away with things. This is not, it's a market you have to be very careful in if you play it at all.
Right. Well, thank you for the insight. That's going to do it for us today. Make sure you join us on IBD Live tomorrow. We usually start 10 minutes before the market open and go for a full hour and a half analyzing the market action. And I'm sure there's going to be a lot to talk about tomorrow.
And we have Brian Shannon tomorrow.
Oh, that's right. Yes, we do have our special guest, Brian Shannon.
He's going to be returning tomorrow. I'm looking forward to hearing what he has to say about the market, get that perspective. As we get all the big bank earnings tomorrow morning.
Absolutely. So make sure you tune in to that, investors.com/IBD Live for more information on how to get that. And please do join us tomorrow again at the end of the day, at the market close. We'll be wrapping it all up and the week for Stock Market Today. Thanks for watching.